a company that since March of 2023 has given shareholders a return of 4.5x. So you've made very, very good money if you've bought it at the low point. But what next for the company? What's the outlook looking like is what we're going to try to understand better. And to that point, they've given an FY27 top line guidance of 1,000 crore from the current sub 700 crore number that they've done in FY25. So that's a substantial uptick that they're penciling in on that guidance. I want to know how much of that revenue comes from new product. One of that is Wagh, other new products within the API basket, as well as CDMO. How much comes from there and how much do existing products grow by to contribute to that 1,000 crore top line. So you'll get also a sense as to how much innovation the company is doing. That's the first piece. The second piece, of course, is what if the cycle turns? And that did happen in FY23. And that's a key risk. If the cycle were to turn, can they still do that 1,000 crore in terms of top line, and what's the comfort there? So that's the first question. The second question which I'd want to know is customer concentration. Currently, it's extremely concentrated, and we will talk about it. 70% plus of the revenue comes from 3 products, and nearly 60% of the revenue comes from the top 10 customers. That's super levels of concentration. What are they changing here with regard to customer concentration, and how real is the risk? How are the agreements shaped? How long-term are the agreements, and how clear is the revenue roadmap is what I'd want to know. The third piece is with regard to margins. They've guided for 33 to 35% margins. That's not very common within the API space. And why is that so? Because API to a certain extent relies on raw materials. But what has Supriya done? They've done backward integration to a large extent. 72% of their products are backward integrated, which helps them. And what that therefore does is gives them a margin lift. But sustenance of that and whatever they're depending on in terms of raw material, is that a risk, and how big of a risk is that? That's the third piece I'd want to know. The fourth piece is with regard to ROCE guidance as well as capex going forward. They've guided for 80 crore capex, but can they do the kind of ROCEs they've been doing? And we will show you those numbers. Very impressive ROCE numbers that Supriya has clocked. So you want to know whether they can continue to sustain that. And one other key piece which I'd want to know is the fact that the margin delivery, of course, we spoke about the backward integration, but also the fact that the working capital days have gone up, and they've gone up substantially. Is that normal course of business, or does that change going forward? That's the other piece I'd want to know. Start off, let's try and understand the company better. I've given some color on the company. It's an API manufacturer. In fact, it has 40 plus years of experience within the API space, and it specializes in niche drugs. I'll talk about the drugs. 85% of the revenue comes from exports and 15% from domestic, and they export to over 120 countries. They're expanding into custom drug production as well, which is within the CDMO basket. And they've targeted a top line of around 1,000 crore by FY27. We've spoken about all of this. Let's talk about products. B2B is what they sell to, of course. They sell API as well as they provide CDMO services as well. In terms of the API, they do 38 APIs for the moment, and they're likely to add another 3 to 4 products in FY26 full year. Examples of the APIs that they do: they cover anesthetics, which is surgery drugs typically in the way one looks at it in common parlance. Then analgesics, which is pain relief drugs, and there is antihistamines, which is allergy drugs, which they take care of. There's also vitamins, which is vitamin B12 derivatives, and there are breathing products as well, which they help in, which is anti-asthmatics, which they take care of. And then there are, of course, a slew of other products which they talk about. But the top 3 products contribute 70% of the top line. And 72% of the product mix is backward integrated where APIs is concerned. And that's where they derive their competitive advantage, their moats from. Look at that, 70% of from the top 3 API products, 4 new launches in FY26 expected, and 4 new launches in FY25, and 3 to 4 planned for FY26 as well. So that gives you a good snapshot of everything. Let's talk about geography. Now, 85% exports, but Europe is 37%. LATAM is 22%. This graphic clearly not signaling that. There you go. 37% Europe, LATAM 22, Asia 16, 3 to 5% is North America. Asia is ex-India, of course, and domestic is then 15 odd %. Now, who do they sell to? They sell to lots of pharma majors. Sanofi, GSK, Teva, Cipla, just being one of the many. They have 1,500 customers that they sell to, but the top 10 contribute 58% of the basket, which is, again, quite large. The concentration is large. Now, let's talk about the metrics, which we always do. Let's start off with the P&L. The revenue has gone up by just about 10% on a YOY basis over the last 3 years. But what you want to look at is the fact that FY23 was a cycle which was a depressed cycle. So actually you saw revenue degrowth in that year. So on the 2-year CAGR basis, we've seen very substantial growth. But that's not the best way to look at it. The important piece here is the business has seen some cyclicality, at least in the past. That's something to note of. EBITDA too was affected as a result, and typically when in a year in which top line contracts, EBITDA would contract far more, and that's what we've seen. And thereafter, we've seen a bit of a pickup, but it's recovered only in FY25 full year. Profitability as well, very similar, just a 7% CAGR on the 3-year profit front. Let's look at H1 FY26 performance. They've guided for a 20% growth for the H1 FY26 or FY26 full year. H1 FY26, they've just done 6%. Again, the guidance from the management seems to suggest that they will do the full 20%. H2 will be a catch-up. There have been a couple of reasons why that revenue number is depressed, and that catch-up will likely happen starting Q3 as well as Q4. Let's talk about the operational metrics. Now, the margins, they're very important in pharma. In the down cycle, they've still clocked a 28% margin, which is quite impressive in that sense. You look at the recovery, it's recovered back to the 36% mark. The guidance is 33 to 35% on the margin count. And therefore, we've kept this neutral largely because there is some cyclicality, but the margins are extremely healthy. That's what you want to keep in mind, which means that they're able to sustain very healthy margins regardless of the cycle. And let's talk about now the balance sheet. In terms of the balance sheet, you'll see the book value at around 1,100 crore odd. If you look at the total book value, borrowing number is very, very soft, just 100 crore. So no concerns there. Capex also not large going forward for a 6,000 crore market cap company. And the cash bank balance sits at a very healthy 100 crore as well. So no concerns on the balance sheet front, a clear thumbs up. Let's look at cash flow now. And you look at the cash flow, what you will see is there's a lead and lag. The cash flow to EBITDA ratio stands at around 60 odd %. So the complete EBITDA is not coming straight to the cash flow from operations. That could be a concern, and working capital is a challenge. There is a build-up in terms of working capital, especially the working capital days tend to fluctuate. That's the other piece I'd want to know, but that is what is coming from the cash flow statement as well. But what you will see on the return ratios, and therefore we've kept cash flow as neutral, but you look at the return ratios, 60%, of course, that's a very high base. But outside of that as well, in a down cycle, it's done nearly 20%. And thereafter too, it's done 20 to 27% ROCE, which is again extremely strong, even for Indian standards. So clear thumbs up with ROCE. Despite the working capital challenges, ROCE seems to be doing very well for itself. That's something you want to keep in your mind. Now, in terms of the shareholding, no concerns here. 68% held by promoters, some FII as well as DI interest, 6,000 crore in terms of market cap, and therefore the free float is just about 2,000 crore. So it's not a very high free float company. You won't see too much DI, FI participation in a 2,000 crore free float company. And that is something you want to keep in your mind as well. Management commentary. FY26 growth guidance retained at 20%, EBITDA margin at 33 to 35%, PAT guidance, PAT margin guidance of 25%. They've just done 6% growth, but despite that, retained guidance, and FY27 top line expected at 1,000 crore. Now let's look at valuations. FY26 revenue approximately at 840 crore is what they'll likely clock. At a PAT margin of 25%, that will mean a PAT of around 210 crore. It therefore trades at roughly 30 times FY26 PAT, but we'll look at FY27 as well. FY27, similar numbers at 250 crore of profit after tax. This one trades at around 24 times FY27, and the 3-year average stands just above that at 26 times. So that's the way in which the valuations stack up, neutral there. Analyst recommendations, no big analysts cover it. 3 buy calls, 1 hold call, no sells. Upside is 26%. Again, a neutral on that count just because of the fact that there's a very small lot size of analysts which cover this one. So we want to be conservative on that count. Now let's stack up all of those metrics, and what you'll see is no thumbs down, which is a positive, but you'll see plenty of neutrals. You want to look at all of those neutrals. Let's go across to management, quiz them. We have Dr. Saloni Wagh joining us on the show today to talk to us about exactly this. Hi, Dr. Wagh. Let me first start off with your guidance of FY27 of 1,000 crore. What happens in the down cycle, Dr. Wagh? Does this guidance still stand, and what's the risk that you may not be able to clock the guidance if there is a down cycle? Talk to us about that first.
So, in terms of the guidance, we are fairly confident that we will be able to achieve our guidance of about 1,000 crores by FY27. And even FY26 is in line with that guidance. Last couple of years, we have consistently grown 20% plus, and I think that still holds moving forward. I would urge everyone to not look at quarter on quarter volatility, because that is very much possible, because it depends on the sale is going in which country, to which customer, if it's a regulated market or a not regulated market. But overall, on an annualized basis, we are very confident we should be able to achieve our guidance of 20% plus growth in revenue.
Okay. And Dr. Wagh, out of this 1,000 crore, you're currently at 700 crore. So to get to 1,000 crore, you need another 300 crore of top line. Where does this come from? Because I understand CDMO will contribute around 60 crore. There's also Wagh, which is the other product that you're getting into. How much does that contribute? And talk to us also about the new products that you're launching. You're launching 3 to 4 new products, FY26. I'm guessing that will be a very similar number in FY27 as well. So give us some color on this incremental revenue that comes in, and where does it come in from?
So part of the incremental revenue will come from the existing set of products, because other than the top products, we have about 5-6 products in our product pipeline for which we have just got the regulatory approvals in the European Union as well as in other markets like LATAM, North America. So a large chunk of this will come from the existing set of product basket. Plus, of course, the other verticals like CMO, CDMO, that is a growing part in our portfolio. Some traction in the new products, what we launched this year also, we are seeing coming in from semi-regulated markets like Southeast Asia. So all these put together would take us to that 1,000 crore mark.
Okay. Dr. Wagh, if I can maybe change the question a bit. So talk to us about the current 695 crore top line you've clocked in FY25. How much does that grow by? To give us a sense that how much will be new product contribution versus existing.
So if you are looking at FY27, I would say about 65 to 70% of the contribution would still come in from the existing products what we have. Then about 20% would come in from the CMO, CDMO on the API advanced intermediate side, and 10% from finished formulation CMO. That's the overall split that you would see in FY27.
Fantastic. And that means that you will likely win more clients on the CDMO side of things, which is higher margin for you as well.
Absolutely, yes. So ongoing effort is there constantly for getting in new contracts which are similar to our DSM Fair Manage contract. We do have 2-3 in the pipeline. Plus the Ambernath site has also just started generating revenue. So that will also sort of add by FY27.
Okay. And do you have capacity to hit 1,000 crore, or would you have to do fresh capex for that?
No, so between our module E and the Ambernath, we already have capacity.
Okay. So if I were to spin this, LATAM contributed around 11% of your top line, now contributes 22%. What has changed there? Have you got new approvals from LATAM to be able to scale that up? And are there more approvals in the pipeline which could surprise you on the upside and therefore could actually help you garner more than 1,000 crore in terms of top line? Give us that sense.
Yes. So we registered last year about 12 new APIs in the Latin American markets. We filed 11 DMFs with CADIFA, and that sort of has translated into that growth.
Yeah, but does this leave you open to other geographies also getting those regulatory approvals in other geographies to be able to surprise on the upside in terms of top line? Is there any, could you give us an indication of that?
So there is no direct percentage that I can give you, but we are actively registering our products across different markets like North America, Europe. So once those approvals come in, definitely it will add to that number. But no specific split that I can give you that how much revenue
Sure.
it will add. But typically 45% of our revenue comes from regulated markets. So that trend would continue.
Sure, but you haven't factored that into the 1,000 crore revenue yet. Am I
We
right in
have,
saying that?
we have already
You have.
considered that, but regulatory
Sure.
timelines take anywhere between 12 to 18 months. So there could be some delay on that. So the full effect of that is not considered, but a large portion of that is already considered in our 1,000 crore kind of guidance.
Okay. And customer concentration, product concentration, it's a very real risk. You've admitted to that
Correct.
on past con calls. What are you doing about that? And does that change, say, by FY27? Because if 70% of your top line comes from existing products, that will likely change.
It will.
Okay. I believe we have Dr. Wagh on a patchy line. We will get her right back, but a very interesting conversation that we were in the middle of. Now, of course, we spoke about this. Around 72% of the current products with regard to APIs is fully backward integrated, which is a positive. But then there are risks, two risks: customer concentration, which is that the top 10 customers contribute 58% of the top line, and then you have also the fact that product concentration, which is the top 3 products, contributes 70% of the top line. So those two are possible risks. But I think what Dr. Wagh was alluding to also is that you've got a 1,000 crore top line, out of which 70% will be APIs. And I believe that will likely mean that the other 300 crore from new products and the new product pipeline, out of which maybe 200 crore will be CDMO, CMO, which is again a positive because it's better margin product. Currently, the CDMO, CMO pipeline is 60 crore odd, if I've understood it right. And therefore, there could be a change in that product mix. Just let's understand. Dr. Wagh, sorry, you were talking about the mix.
Yes.
We lost you. Please go ahead.
So I was saying that we have actively started introducing new products from other therapies. If you look at the new launches also, we are launching new products in anesthesia, ADHD, cardiovascular. So these are completely new therapies for the company. And I think once these products get added, automatically you will see a diversification of customer base as well as the geographic mix. So that is something that we have already been working for the last 2-3 years. So that will definitely reduce that product concentration risk what we currently have. In terms of customer concentration, the top customers which you are referring to, mostly these are distributors. So they in turn, individual distributor caters to more than 100 customers. So as such, I don't see a risk in terms of the customer concentration. It's basically large distributors set up across Europe, Latin America, which we have introduced to have ease of business with the customers. So product concentration we are taking care of. Customer concentration, in my opinion, is not very large in our business.
Okay. And new customers, are you accessing them as well? And what's the opportunity size like?
So yes, naturally, with the new product line coming in, with the new therapies coming in, that will open up a new customer base for us. Like I mentioned, we have not been in ADHD or cardiovascular before. So not only is it opening new customers, but it is also opening new geographies. Like if you look at North American contribution today to our revenue is very small, about 4 to 5%. But once these therapies open up and the customers come in, that percentage will also go to about 8-9% in the next couple of years. So definitely a lot of focus is there on introducing new customers also in our current business, which will happen eventually with the launch of new products. Plus CMO is a big opportunity for us. CMO will add a lot of multinationals to the mix, which we currently don't have. After the DSM Firmenich contract, we are working with 2-3 other large players. Hopefully, in the next couple of quarters, we'll be able to announce one more large tie-up like DSM.
Dr. Wagh, why do your working capital days fluctuate so much?
So on the working capital front, I would say that there is not much problem because there is no issue of debtors or anything like that. It's mainly driven by our inventory days because inventory days are slightly on the higher side. That's mainly a conscious call of the company because we are fully backward integrated and we cater to regulated markets. So we need to have sufficient inventory in case of any geopolitical issues. We cannot have a disruption in our supply chain. So mainly it's the inventory days that we have to work on, but we are actively working on bringing down the inventory days. As such, I don't see any issue on the debtor side.
Sure, and backward integration, of course, also means that you get better margin delivery. How much of pricing are you able to control, and how confident are you of the margin delivery of 33 to 35%? And is it only and purely because you're backward integrated?
Yes, absolutely. I think backward integration plays the most important role in the margins of the company. Backward integration and being in regulated markets. Because we produce our own intermediates, we have full control of the cost as well as our supply chain. And that is sort of getting added back into the margin. Because we have backward integration for almost all the top products, which today contributes to 80% of our revenue, and we have 40% plus kind of revenue coming in from regulated markets. A combination of that is what is enabling us to have those margins, what we are enjoying today. And we are very confident that moving forward also, we will be able to maintain the margin range between 33 to 35%.
Dr. Wagh, if I'm understanding you right, you have an incremental of at least 300 crore of top line which will get added, right? And you've just got 80 crore of capex likely in the pipeline. Your ROCE should shoot up dramatically if this were to happen. Am I right in understanding that?
Yes, the main reason for the new capex number being limited is because if you look at the last 2 years, we have done quite a large capex, about 250 crores between our current API site. We set up module E for capacity enhancement, which has almost doubled our capacity for API. At the same time, we have set up our new finished formulation division in Ambernath, where we have done another about 150 crores of capex. So in the last 2 years, we have done almost 250 crores of capex. And the Ambernath site is fairly new. We still have not got the regulatory approvals for that. So I think once the regulatory approvals for that sort of come in, you will see a better sort of a run rate amongst both API as well as finished formulation. And the incremental capex, what you're asking, that 60, 70 odd crores, that is mainly only for the maintenance capex, which we will require at the API site. And that is majorly for debottlenecking of some of our older blocks because we want to actively introduce automation in some of the older blocks. We want to debottleneck for increasing the capacity for backward integration.
Dr. Wagh,
yeah.
Dr. Wagh, I'm tight on time. So FY30, if I were to just push the number to FY30, what's the kind of top line you can clock?
So you can expect to grow at 20% plus year on year. So that's the number that you can look at. From 27, again, the 20% plus revenue growth guidance still holds. So we are on a fast growth pace track.
Understood. Great. Dr. Wagh, this has been a very good conversation. Thank you so much for joining us and giving us your time. And viewers, that's all the time, frankly, that we have with regard to all about your company today. Thanks so much for tuning in. And it's a goodbye from all of us here.